The overall message seems to be in line with expectations, but some adjustments to the way they're thinking about the economic outlook. What's your initial read, Simon?
Well, as you say, no great surprise. As the diminishing downside risk as a result of vaccine, I mean, I would say they needed that. I mean, their growth forecast for next year, 7.3%, is still pretty punchy. They also don't, I think, have that much permanent scarring in the economy as a result of the pandemic. So yeah, there's still plenty of scope for downside news on their GDP forecast, as far as I'm concerned. But overall, they're obviously seeing smaller downside risk. I think the unanimity at this stage was also quite key. We can probably see UK policy on hold for a few months yet.
Now, Simon, they do have a line in here with regards to the trading negotiations saying that the outlook depends on the pandemic and the transition to the new trading arrangements between the European Union and the United Kingdom. Just how important are these Brexit negotiations? What's the sort of spectrum of possibility that we could see in a no-deal scenario versus some sort of trading agreement being reached?
Well, the Bank of England still has in their central case a move to a fairly comprehensive trade deal. Still, they assume from their agent surveys that not all companies will be ready for the change at the end of the month, and therefore they took 1% off of the level of GDP in Q1 in their November forecast, just as a result of the trade disruption. But that dissipates by the end of Q2, so it's all over pretty quickly in the bank's mind. Now, the question is, how big will the disruptions be? Will it be over that quickly? And of course, how comprehensive will the deal be? Let's set aside no deal, but what we're looking at is probably going to be a fairly thin deal related to goods, a tariff-free deal, but not regulatory checks. They will still be required, and very little on services. So there's still, again, I would suggest perhaps some scope for downside news for the bank, depending on what we ultimately get from that deal, assuming it happens.
And putting Brexit aside and perhaps looking a little bit more closely into the state of the UK economy on its own, linked to the pandemic developments, do you think that the Bank of England's tools are less effective than normal at this stage?
Well, I think generally and across the developed world, monetary policy is at the limits of what it can do. And I guess similar to the ECB, in large part at the moment, monetary and fiscal authorities are pulling in the same direction. So the Bank of England is going to do what it can simply to support government borrowing and support loose fiscal policy. So yes, I think their tools are somewhat diminished. And I think implicitly, Governor Andrew Bailey has admitted that. He says now if we're going to do QE, if we're going to do policy, we want to go fast and go big. They need to get the biggest bang for their buck with limited policy headroom left, and they want fiscal policy to do the heavy lifting.
Simon, I just want to link the Bank of England monetary policy outlook to what we've heard from the Swiss National Bank today. And, your point about the Bank of England potentially going down the path of negative rates or more seriously considering it in the future. If they do go down that path, to what extent does this drive further upward pressure on the Swiss franc and spur more interventions from the Swiss National Bank?
Well, I think if inflation continues to be very weak in Switzerland, and they do need to do more, it will be currency rather than rates that will be the SNB's tool of choice. But I do think that the vaccine news, as the economy recovers through 2021, that should take some pressure off the Swiss franc. So it should be roughly stable across the year. That hopefully, from the SNB's point of view, will reduce the need for more intervention and more monetary easing. But I think probably things have to get considerably worse before the SNB would take its policy rate lower.